Hello and welcome to another episode of Angel Insights, the show that goes deep into the world of angel investing. I'm Tom Britton, co-founder of SyndicateRoom, and if you want more on our flagship Access EIS fund, head on over to www.syndicateroom.com or follow me at Tom Britton or SyndicateRoom at SyndicateRoom on Twitter. A few months back, I had the chance to sit down with Addie Pinkster, chief exec and founder of Adelpha, and learn a bit more about her career, thoughts on angel investing, and where the market was heading. Bit of a spoiler alert, but she's been right about pretty much everything so far. And there's a lot more to come. So grab a warm drink, sit down and tune in, because it's going to be a great episode. Addie, it's absolutely a pleasure to have you on the show today. Where are you talking to us from?
I am talking to you from my home in Putney, overlooking the river.
Fantastic. Good. So let's crack on. You've got quite an interesting story. You did Cambridge, MSc, Judge of Business School, Goldman Sachs, UBS, Citibank, and then you founded your own company. I want to hear what that was like for you. Like, did you go into university thinking, yes, I'm going to be in finance, or was it something you kind of found your way into?
No, I didn't. I'm the youngest of three, and my brother and sister are much older than me. So even as I was hitting university, they were in their late 20s. And I think between them and their friends, that gave me really good visibility of different careers. And I think something that I did, which I'm grateful for and I recommend others do, is I didn't ever think too far ahead of time. At most, I had a 5-year plan. But mostly what I thought was, what do I enjoy doing today and what am I good at today? And where should that take me? So most of my time at university, I earned my money teaching sailing. And funnily enough, actually, I think that had a real read across to what I went on to do. So I thought, what do I like about that? It does take skill. It does take learning. It really is about emotional connectivity, understanding what the sailor or the client needs from you, building their trust and applying yourself. So what I really started doing was thinking about, who am I? I'm someone who likes relationships, but I like substance and material. I like to think on my feet. And I clearly remember asking my brother and sister's friends what they thought I should do. And at the time I was like, should I be a barrister or a management consultant or work in a bank? And they all said, you're definitely a banker. You're definitely market side. And I started to think that things like management consultancy and law and barristers and those sorts of things, they're just too long to the end goal. And I am more instinctive. I'm a bit more of a sort of a sportsman. I like the race in front of me today. I mean, that's why internships are great. I did my first internship at Goldman Sachs, which allowed me to learn about the markets, see different desks. And I just really found my niche. And that rode me really nicely through my 20s in a way of just feeling like I belonged and was able to get my teeth in and work hard and hopefully do well.
I think you were far more forward thinking than I was at that age. I thought I'd go to university, study economics, get an MBA and do it all in a short span. And then I got distracted by many other things. And like
something I reflected on in my early 20s was that generally my guy friends all had 20-year plans. I remember someone saying that their mother had said to them, don't own a Porsche when you're 30, own Porsche when you're 40, which is a pretty strong statement. But they had this idea of where they wanted to be when they're 40 and the idea of providing for their families. And my female friends had a much stronger feeling of, who do I want to be tomorrow and in the next 5 years? And I actually think at the age of 30, my female friends were much more successful than my male friends, because we worked aggressively hard at things we were applied to and interested in. And then we all generally had timeouts for the baby section in some way. And the guys caught up. And also now the guys who had the 20-year plan, it's all coming off age 40. But I did notice a bit of a gender divide of how people approach their careers at that time.
No, I mean, that's an interesting one. And I'm sure we could delve into that a lot. But I'm kind of interested in your career trajectory. Talk me through it. So you went from Goldman to UBS. So kind of one big firm to the next. What was the reason behind the shift and what were you doing at UBS?
So I was always market side, but at UBS, there was discussion about whether I joined the equities cash sales team or the sales trading team. And at the time, classically, graduates and people who looked a bit like me joined sales, and the makeup of the sales trading desk was a bit different. But I looked at the sales trading desk, which the long history of it was blue buttons who'd run pieces of paper up and down trading floors. And I really felt very high conviction it was where it was at. The technology was coming in, everything was starting to be traded digitally, and it looked to me like it was the heart of everything. And I think it was a bit of an unusual choice at that time to ask to go into sales trading and not into sales. And the other thing I did at that point as well is there was this tiny corner of the desk called hedge funds, 2 or 3 guys. And I very much angled for that desk as well. And my reasoning at the time for that was that the content discussion seemed very, very high. Every call they picked up, it was to really infer information. And they were judged on the quality of their information and moreover, the outputs and the trades that came off the back of it. And I really liked that. And there were really great people across the rest of the desk as well. But those relationships were a little bit more like, here's what's happening today. Here's where I've got liquidity. Shall we go out for a glass of wine tonight? What I warmed to in the hedge fund sales trading desk was they're evaluated by what is the outcome of your input? Like, can you give me information that helps me make a better trade? So I joined that and I was just in the right place at the right time. I went through 10 great years where hedge funds became a dominant market segment in their own right, and then family offices and then alternative asset management. The other interesting thing about those 2010s was that different themes evolved. So at one point I was doing risk arb and merger arbitrage trades, and at other points I was doing long short, and other points I was doing macro, and then I was doing cross asset. And I sort of, at different periods, I really took on different aspects. The other two things probably to say. One is my background. So I am EQ and IQ. I did 2.5 maths A-levels, but I went to Cambridge, I read social sciences. But then when I was at the Judge Business School, I was doing the engineering modules. So I've always liked both. And on top of that, I really like people. So for me, the idea of any career that allows me to get my teeth into something really substantial and use that as a way of servicing relationships is great. And on top of that, if I can then bring data analytics on top of that, that's even better. And what UBS was for me for 10 years was a great family and a great culture, but it had really, really good leadership. And from that position I had of privilege in the middle of the trading floor, I was able to look at all aspects of the market, which intrigued me on all areas of skill set, whether it was like people and trust or data analytics or trading and outcomes.
I want to come back to that later on when we talk about angel investing, because I always have this theory that the best entrepreneurs are either pure scientists and they hire good salespeople, or they're brilliant salespeople and they hire good scientists. And you clearly have that experience of being on the sales side and also the people interaction, but then the data analytics. And I'm wondering how that comes out in your due diligence on companies and what you're looking for. But park that for now, because I want to talk a little bit about Citi, but more about then how that led to you founding your own group, your own company. So quickly talk us through Citi, and then what the event was that led you to leave all this probably high-paying big corporate world and start your own firm.
It's funny, I never thought of myself as an entrepreneur, but what I did like is building things of legacy. And I did actually feel at UBS at the time that I'd made a lot of the contribution I could. My clients were well serviced, that everything was working well. And at Citigroup, I could see so many areas that I wanted to contribute to. And what they really offered me was challenge. You know, at the time, UBS felt just a great place I could have been for the next 30 years. And Citigroup was sort of saying, here's a really difficult problem. Can you come and solve it? And that felt really, really appealing. So I went there, and then I had a second child, and within a year of being there, I was moved into this hedge fund strategy role. So it's basically looking at growing the entire hedge fund franchise on an extended basis, and that was all really good fun. I did 2 pretty big jobs there that I felt had kind of completed, and I wasn't quite sure where the next job was. And in the meantime, the markets had changed, and I was going around talking to all these hedge fund principals, and their opinion was the same as my opinion, which was this asset class, it served us so well. It's where we've wanted to have all our money for a long time. But right now, it feels like it's low inflation rates, and property feels down, and equities, there's so much stat up in there. The volatility is high. I'm not sure if I can justify my fees. I didn't want to put my money into it anymore either. And on top of that, we were playing with data sets to try and get edge in the markets. And we were trying to get ready for MiFID II. And we were using interesting freaky stuff with data. And through all of that, what happened was I just started to feel a little bit higher calling or a different calling. I just felt, I want to put my money in a different asset class. I want to go earlier. I want to go tech. I want to go growth. And through some of the introductions we were making to asset managers, we were generating multi-million ARR revenues for companies that were 5 years old. And I was in public markets where we had redundancy rounds and margin compression, and we were fighting over single basis point growth numbers, and moving to a sector that had 40, 50, 60% gross margins was doing 10 to 15% month on month growth. And it was actually making the world a better place too. It was everything that makes the world technicolor and exciting. So I privately started investing in some of the companies that I was helping with. And I felt like I had edge in the way that I hadn't in the markets for a while. I had this image that if I walked through Mayfair and I phoned a fund manager and they were in a meeting, they'd stop their meeting and go, sorry, this is Addie, this is going to be important, I'll take it. And if I phoned someone, it was because I had something fun to say or exciting, or I had a person introduced that was going to change how they thought about things. So that was really where I got to. And I wondered how to do it. I thought about going buy side and setting up an investor group and just formalizing some of the investors that we were doing already. But by the time that I left Citigroup, it was pretty apparent to me that what I wanted to do was set up a corporate finance house.
Was the decision to leave because of it, or were you just like,
No, it was a pull. It was a pull. I wasn't one of those people who was going, I really want to set up a company, let me go and find a good idea. I would never have backed myself to set up a company. I was hugely inspired by my cousin, Poppy Model, who'd set up a funeral company. But the way she did it, and what I found was I suddenly saw something that just had to be done. And on top of that, I felt I'm the person who can do this. And it was a real overwhelming of I have to do this, and I have to do this right now. There was one other aspect that was interesting, which was coming out of having had 2 children. I really felt conscious that I had this enormous amount of energy ahead of me and a lot to apply myself to in a job. And I therefore felt it was a moment in my life that was very important to work out which direction I was facing in. And I had this sort of idea of being a tanker or a nuclear weapon or something that was about to project quite hard and fast for 10 or 15 or 20 years. And therefore, every millimeter of angle that I get more correct is going to hit the target better. So I did spend a good 6, 12, 18 months thinking about what I wanted to do. And I tested a lot of ideas, and I started by practicing and trying, and I refined, and we came up with Adelpha.
How do you test that type of idea, though? I'm curious.
Yeah, and that's something that people generally think you can't do, but you completely can. For people who are thinking about transition, I mean, just for example, as part of our curation process on deal flow, we have some 9 stages, but the middle stages is something called a strategy session, an investor committee meeting. And in those, we never are the only people in the room. We normally have 10 other people who don't necessarily know each other, different backgrounds, experiences, but they are pros. And for someone who is already in a job, whatever that sector is, if they just come and spend an hour of their time in that room, you learn a lot about what other sectors and stages look like. You start to make meaningful relationships with other people because you're coming together over content, and that happens. In my case, I was starting to get approached by my clients to go and join them. And in doing that, I realized how much bigger the world was and different sectors. And that made me reflect on what I wanted to do and not wanted to do. I was leaning into the companies I'd privately invested in. So I was getting much more into the nuts and bolts of what the day-to-day challenges and opportunities look like. I thought for a while I was going to go and join a VC, but I was on gardening leave. So I spent time with them without being employed by them. And that probably helped me not make quite an expensive mistake in terms of my resource, which is, it wouldn't have been a good fit for me, but it gave me exactly the straw man off which I could reflect about what I would do differently or how I wanted to do it. And one of my theses is, with respect to you, Tom, having spent 20 years plus supporting funds in very close proximity, I'm pretty clear I don't want to be a fund manager. I think it's tricky. And as a lot of it's raising money or keeping investors updated or governance or structure, what I really like is markets and finding great opportunities and creating tribes and families around companies to help them grow. And actually, you can do that from the sell side rather than the buy side. And I think my natural instinct is better served on the sell side. I like servicing people.
No offense taken. No, I mean, it is quite interesting. And had you gone VC and stuck to a specific structure, it would have limited your ability to actually help the way that you wanted to help. Like, it makes complete sense from what you've said. Tell me then, though, like Adelpha, for those that don't know about it, tell us a little bit more and what you do and what you focus on.
Sure. So we're a corporate finance house and we work with UK headquartered companies, but they're normally growing internationally. Size-wise, they're normally growing from about 10 million EV to maybe 150, 200 million EV. So it's not ideas and spreadsheets. It's quite proven traction, but it's in the sort of supercharged level of growth. We're 5 years old this month, actually.
Congratulations.
Thank you very much. We've advised on about $750 million worth of transactional value, maybe a bit more than that. But we're extremely selective about what companies we work with. That $750 million of transaction fees has only been in about 140 transactions, and that's only been for about 40 companies. And in terms of curation, we get approached about 100 to 300 times a month with people who want to meet us or potentially work with us. And we sign a new client roughly every 3 or 4 months. So it's a kind of a up to 500, 1,000 to 1 curation system. Sector-wise, we are officially sector agnostic, but we basically are pretty solidly B2B rather than B2C. We really like infrastructure. I mean, we're software and tech and data and IP, high growth areas. We really like sectors that provide infrastructure to other growth companies and spaces and verticals within sectors. And there's not a good word for this, but we're sort of futurists. When we get really into a theme, we generally spend 2 years telling people about it and explaining the theme. And then suddenly people cotton on and we spend 2 years not having to explain the theme anymore. But to put that into context, gaming, as in video gaming and what's now called the metaverse, we were on that 5 years ago, and some people pick up the phone and other people were going, oh yeah, I guess I should have some exposure. But now everyone knows they have to have exposure there. And clean tech and climate tech, things to scalably remove carbon dioxide from the atmosphere. For probably 2 or 3 years, we were sort of starting conversation saying, give me 10 minutes to hear me out on this. And now people are like, yeah, it's going to be an industry bigger than oil and I have no exposure, and how do I get in and what does good look like and bad look like? But that in itself wipes out quite a lot of sectors for us. For example, within clean tech is clean energy, within clean energy is hydrogen and even batteries and storage. And I'm really clear all of those are nascent relative to where they could go to, but they're too mature for us. The market and fund managers understand the concept of hydrogen and batteries. And on top of that, I actually think they're tricky-ish markets at the stage we operate in. So that's an easy skirt for us. If I'm not phoning someone up with Edge that's taking forward their thinking, it's probably a bit too mature for us.
So what in that space do you think is early enough for you?
Well, we've looked at hundreds and hundreds of companies in that space. And actually, a lot of them we don't take on for reasons other than sector. But within it, we've signed 4. One of them, we are really, really interested in carbon removal, which is the ability to go into the atmosphere and directly remove carbon dioxide from it in order to then sequester the carbon dioxide and just remove it from the atmosphere. That is a difficult market, but we have one company that we are really pretty convinced is very well on its way to being able to do that scalably, and on top of that offer open source infrastructure for other companies developing other structures to do that as well. And that is exciting. I mean, apart from anything, the team's phenomenal, their traction's phenomenal, what they're doing is great. They're all humble and hardworking and detailed and analytical and brilliant engineers, and they're doing it on an IP basis. But when I look at the potential returns of that, even aside from the legacy that you leave for the world, it's a $6.5 billion recurring revenue opportunity on the first application, which on those kind of margins and EBITDA numbers, like a couple of yards of revenue on a 80% EBITDA margin.
Tasty.
You can actually back of the envelope see that being a $40+ billion valuation, not even just within our lifetime, within my children's education. So that's super exciting. Another thing we've done in the space of quite a lot of data, we've got a great company, Agricarbon, that is all about providing the structure to be able to measure how much carbon dioxide gets absorbed into the soil, which is sort of the stumbling block that's stopping a lot of that side of the natural carbon removal market working. And they're brilliant. We've done other things in IP that just makes electricity cable much, much more efficient. It's like a $90 billion market and growing, but 6% of electricity that gets generated gets lost between source and delivery. So just having an IP to make a better cable is a game changer. Those sorts of things.
We had a Nick Lyth from the Green Angel Syndicate on a video for Earth Day, and he was talking about incremental changes. And I think he shares similar philosophy where obviously you've got groundbreaking innovation that's going to disrupt everything. But actually, most of the steps that we need to take now are little bits and little bits and little bits. And things like cables, making them more energy efficient, doesn't seem as sexy as it's going to pull everything out of the sky and turning into diamonds, which someone pitched me because it's all carbon. But it does feel like that's what needs to happen now. So I definitely get you on that. So beyond sector, there are definitely some things that bond these companies together that make them appealing to you. And I was wondering if we could talk a little bit more about what you're looking for in a company that you engage with.
So I think if I go top of the waterfall down, it needs to be a sector that is undoubtedly, absolutely going to permeate everything we do. And for example, metaverse living and carbon removal and clean tech is so obviously going to be huge. Then we're looking for niches within that sector that aren't already quite well played. So it has to be somewhere where we have edge and we're not competing against the world and its wife to talk about it or to try and invest in it. And the way I think about that is like a sort of tidal wave. If the tidal wave is moving forward, even if the company slips back, it's still definitely moving forward. At worst, it's going to get taken out for market share, but hopefully much, much better. So vanguard companies on vanguard themes. Then we come down to the company itself, and we have a qualitative and a quantitative analysis sheet. And it's not that you sort of add up the numbers and if you get over 80, you get an investment. But it does make sure that we actually think and ask the questions that our unconscious bias may encourage us to forget to ask on a company that we really like. The first thing is we're really intolerant of red flag behavior, and we look for it from first meeting. Exaggeration of statements, comments, those sorts of things, not good. We want realism. I'm much more someone who wants to see people with their makeup off and their metaphorical pants down and see how they face adversity than to see the polished pitch. I do see some investors on the private side who really lean into polished pitches and bravado, and I think they're missing a trick in terms of their portfolio management for that. But equally, they do need to be able to pitch. It is such a difference working with a CEO or a founder who can naturally tell their story day in, day out, whether they're in the pub on a Friday or in a big meeting or a small meeting, whatever else it is. We really like to see governance, but I think above all, we want to see execution. And I think you can assess that from the very first meeting. Normally something comes up at the first meeting we want to see more on. It already gives you an idea of what their internal systems look like behind the scenes. And that is really indicative of how they run the company. And even how they present, they don't need to be super polished to us, but especially in a B2B SaaS or IP or data company, they will be facing onto big organizations all day. So someone who can present cleanly and well and look like a professional outfit, that helps a lot. And then it is about team. And it's a real blend there about, do they have the right people? Do those people look like they're productive? And also, I'm never crazy about founders and CEOs who talk about I all the time. And one other thing, and even after we've done all the assessment about, and valuation obviously is absolutely paramount to us, but even we've gone through all of that, like sector theme, company, financial model matters to us a lot, and actually really strong financial capabilities within the company. It's especially first-time founders. The idea in the spreadsheet, the rough model, realism there, like proper allocation of resources for customer success. If you're looking at high growth, by 2 to 3 years out, I want really big contingency lines on costs. I want extra run rooms going into predicted rounds. Just classically, especially first time, it always costs more than you think. And making sure that's properly budgeted and understood is helpful, and a bunch of other stuff.
You've highlighted a few things there. I think valuations is one we'll talk about in a second, but looking at good governance, because obviously ESG is becoming a big thing. It's kind of a buzz term, if you will, but
Yeah.
I feel like governance is the one that often gets overlooked and how companies are run and structured and board composition. Love to get your thoughts on that and what you're seeing and what you think is good practice for startups, not just on board, but general governance.
Sure. I mean, ESG is such a funny one, isn't it? It is such a hodgepodge of terms put into one as a bit of a fail-safe. For me, E, environment is an investment theme. S, social is an investment theme, and both about doing the right things, but it's about morally doing the right things and having impact on what legacy do you need to leave or want to leave. But the G is paramount to running a good business properly. So it's really odd that they all get put together. If we come on to the G, so governance is everything. And actually, in particular, having a board with independence on it is probably the single biggest lever that a high potential company can make to achieving what they're capable of in the first 2 to 3 years. Again, it's something that I see gender can play a part in, but some people, especially actually VCs, will often say that I go too early and it's not necessary. But actually, I think it's stuff like what I'm about to say that enables companies to grow and have good structure that they don't necessarily need a big VC to come and lay it out for them. So I think pretty much from day one, and especially early, you want a board. And it can't be your mate, and it can't be people who have the same skill set as you and the same background as you. So classically, if we see someone who worked in strategy at L'Oreal setting up a company, their starting board generally tends to be other people they worked with at L'Oreal. And you need to actually have, to have someone who's finance, someone who's law, someone who's this, and different personality types and all that sort of stuff. And try and meet once a month. Even if it's quite informal, just try and meet once a month and say, this is what we think we're going to do next month. Next month you go, this is what we've achieved. This is going right. This is going wrong. This bit feels good, but actually this bit's not so good. Has anyone got any ideas or thoughts or help? Holding yourself to account is really helpful.
You mentioned 3 there in terms of what people should be looking for. Is that the right number earlier on, having 3 on the board with 1 in finance, 1 in commercial, and 1 that's either like legal or governance?
Yeah, I don't think there is one size fits all, and it depends what the stage is. If I think there's a company that's a second time founder, sold his first company really well, he's just setting up now. And in the first place, his board is going to be him, 1 other exec, and 3 others, myself included. We're all quite in the mix. I've advised him and I'm an investor and there's conflict pitting around, but basically it's like, hey, let's just start with something so that you have a room to talk to. And over the next 6 months, you can talk about rolling us off and bringing on others, but at least we'll give you the room and the audience that can give you clean space and head time to start with.
Do you think that it has to be official board members at that stage, or
No, I don't think you have to be directors at that stage. In fact, it's slightly better not to be, I think. But so advisory board or however you want to think about it. But do think about it as a board and don't think about it as a token get together and a bit of a chit chat.
Don't host at the pub.
But I think it comes down to different companies. We really believe in strong chairs and having chairs early. And in particular, a chairperson or chairman can fill lots of roles. They can be door openers or ambassadors, whatever. The thing I care most about for chairman in the early days is that they chair the board. So we generally often advise is that you're building up a board of really good advisors with different specialisms. But above that, you have a chairman who is running the board and giving clean space for the discussions at hand to go from A to B to C and making sure that certain topics get car parked but brought back and brought in. So in our experience, Mike Rowe, who's the CFO who grew Just Eat, he's chair of ProSapient now, started as a board member and moved into the chair role. Rupert Pennant-Ray, former Deputy Governor of the Bank of England, was chair of many FTSE companies. He's been a phenomenal chair for us. And in those environments, he pretty much comes in. Everyone has definitely read all their papers. And he starts by inviting the CEO to present. So the CEO is not then chairing and presenting at their own meeting. He then systematically makes sure you go around the room, both the introverts and extroverts, because otherwise you have extroverts talking all the time and introverts never sharing their opinion, and make sure the actions are well kept and goes forward. And the other invaluable thing that a chairperson can bring is just that solidarity to the CEO. Like I look at Ben Turner, the CEO of Origin. He's really shifting the world right now. But as we all know, that can be a lonely and sometimes scary place. So knowing you've got a chairman by your side and there is no daylight between you, and you have solidarity and a running partner and someone that you can just phone to talk certain things through, and sometimes that's enough, is great. The other thing I think is really important is, this may be a controversial thing to say, but once you have a chairperson in place, and if it's a good chairperson, and if they're experienced and trustworthy, you also have your check and balance against the CEO or the founder. When is the time for the founder to step sideways or away? or the CEO, and are they having a proper performance review? The most important person in the company, are they having a proper performance review every 6 months? And is there someone who will turn to them and go, I think your skill set's starting to become limited for what the next stage of journey is? And making that conversation open and discursive and not scary, and something that as a CEO or founder you have to go to bed fearful of, that you're about to be kicked out or not. It doesn't need to be that way. It should be a grown-up conversation, well managed, that as a CEO or founder you sit there going, I'm really comfortable and happy in my job because I know I've got the support of my chairman, and if he had any questions he'd say it to me first.
Are there any things when you're reviewing the company and talking to this founder CEO that are red flags that they wouldn't be able to handle that, or green flags like, yeah, this person is going to be able to take that on board, beyond the fact that maybe they were previously successful with another company? So if you're looking at a first-time founder, what are you looking for in that?
I think the ability to take feedback is massive. Our strategy sessions in ICMs, they're very, very intense hours. They're really friendly and approachable, but they're intense. The idea is to try and move a company forward in an hour. So classically, people come in, introductions, company presents for 10 or 15 minutes, there's 20, 30 minutes of questions, and then there's 10 minutes at the end of feedback where people around the room speak for a couple of minutes each about whatever they think. And someone called it the board you can't afford the other day. But let's say coming out of that, what you get to see is, and generally the founder or the management team walk away and they're exhausted for 24 hours, and they email back about a week later, or they phone us and say, God, I was tired. It was like going to a psychiatrist. I was just so exhausted. But I've now had time to digest it. And my favorite response when they go, these are the 10 things that were said to us. These 2 are brilliant. We've already actioned them. These 2, we've done a straight discard. We don't think the person who gave it to them had the context. We just don't think it's the right call, or there was a misunderstanding. These 4 are good. They're on the slate. These last 3 are the ones we want to talk about. This one, we're interested to explore more. We want to understand more about what you mean and how to think about that. And these 2, we kind of want to do, but we really don't know how to take the first step towards it. Can we explore that more? And that, for me, shows that they can take feedback, but they can also make their own decisions. But mostly they can execute. They've already done 2 of them, and they're coming back to ask how they execute better on the last 2. I think that sort of behavior is very strongly indicative of how a management team works, and that will infer across a company as you go forward. In terms of us taking on a company, having everything else we've spoken to, the last thing we think about is, are we a good fit for you? Can we actually help you? This might be the best company in the world, but can we help you? Do we know the sector well enough? Do we know where to place you? Do we have experience? Do we have credibility? The second question that goes through our mind is, do we actually get on? Are we going to have a good working relationship, or is my style going to grate you, or vice versa? And the third actually is, are we going to enjoy this? Adelpha, we've had a good 5 years, but we are here to enjoy our work and make a contribution we're proud of. And sometimes you just know that even though you're producing something of value, it's not giving you that inner sense of self. And all of those would be good reasons for us to not take a client forward for some reason or other, but hopefully with respect and admiration, basically saying you'll find someone better elsewhere.
I mean, a lot of it for you is representing your investors as well, especially if you're going to take a board seat, and making sure that you reflect them fairly to the company, and the company's getting the most, like you said, out of your network. So
yeah, I mean, to be clear, we are a sell-side organization, so we represent the company. We have very good relationships with investors, but we don't take payment from investors. We don't take carry. The reason we're aligned with investors is twofold. One is I am an investor myself. If Adelpha's taking on a company, I almost certainly am investing on equal terms to all other investors, and we're transparent with that to all parties in any round. My main point is that the company needs to care about their investors, and it's a long-haul game, and they need to do what's right. This is about building a tribe or a family or a village around the company to succeed, and that means extremely high levels of communication, transparency, and trust and respect from a company to their investors. So the reason I care or take any of those roles is to help the company fulfill their responsibilities to their investors to the highest ability. It's not because Adelpha is representing the investors per se or taking any conflicted position towards them.
You obviously see a lot of companies, they go through this process of yours, and the chosen few make it out the other side. You're wanting to invest in them. And with the investment discussions comes valuation.
Yeah.
And you and I have had a few chats about valuation. I would love to start with getting your thoughts on where we're at in the cycle, in particular on early stage investments, and how that's reflected in the valuations and where you think it's headed.
Okay, we're at the top. We're at the top of a pretty big private equity bull market. It's been a really interesting 6 months because public markets rolled around December. And they rolled in most of the ways that a public market can roll. They came off their highs. You start to see high volatility. You saw sector rotations. You saw defensives outperforming tech. You saw valuations start to crunch down, especially in higher growth sectors. What's interesting is I then started to get a few calls from people saying, public markets have rolled. We think private equity markets are going to roll. And for me at that point, they were really quite segregated, certainly in the stages we're sitting at, sort of pre-Series D. That didn't worry me in itself. However, the structure of the private markets in their own right was giving me cause for concern. The amount of assets that are sitting on the sidelines in alternative assets is astronomically high. And we've got a company that is a really good leading indicator on that. And they're high and they're not going anywhere. And they're so high that even in a pullback in private equity markets, that's just an opportunity for some of those assets to go in. But we've had such an extended run now. And actually looking at the data, it started around June 2020. It started way before people psychologically realised it started. But if you talk to anyone in private markets, they haven't had summer holidays for the last 2 years. And then you're starting to see it in valuations as well. So if I look at SaaS multiples, the way I would think about it is a really good idea in a spreadsheet, not that Adelpha tends to operate there, but a really good idea in a spreadsheet from a founder with good reason to think they can make this work. At a starting point, I think you can talk sort of 1.25, 1.5 million EV pre or post money. But you start to enter the valley of death then, which is the race to revenues. And once you get to revenues, there was really clear literature from the West Coast for the majority of the last 10 years that said you don't want to be paying more than 8 to 10 times current ARR. And that is current, not 1 year forward. Ideally, it's real ARR, i.e. it's contracted, it's recurring, it's not pilot, it's not just high visibility, regular revenues. And that was for good performing companies. And actually, even 3 years ago, before the current real rush, SaaS companies in the UK were exiting at 6.3, 6.4 times ARR. So you had these SaaS companies going out to raise early stage money from classically angels at 14, 15, 16, maybe even 20 times a 1 year forward. And they were selling on maybe 6 or 7 or 8 times 3 months trailing. The difference in valuation for that is massive. And that means that as an investor, if I come in now, the company's going to have double revenues in the next year for me to potentially stand still for an exit value in a year's time. I think what's interesting in the last 18 months, though, is it's just got ahead of itself. And even I now have been paying up higher than those metrics for SaaS and IP and data. And I've seen valuations go much higher, but stuff that we have been willing to associate with a tool has gone as high as maybe 20 times current revenue run rate.
Is that across stages or in particular with later?
Classically B2B SaaS at an enterprise or SME level. How much I'm willing to pay or overpay versus what I think is fair value comes down really to the company's ability to meet targets and beat them, which comes down to running their systems well and being able to talk about that articulately. The sector, which is really different for me, is the clean tech sector. It does take a bit more money to get set up, but it's not like biotech levels where you get set up and you have a binary outcome. You have really good lead indicators as it's getting set up as to whether you think this is going to work or not. You're getting a lot of leverage on your investment because some of the companies we've got are applying for £100 million worth of grant funding. So for every $10 million of equity investment, that's being matched 10 to 1 by other areas. Because there's often a physical infrastructure play somewhere, there's then debt leverage to play on top. So firstly, that really changes your ROI on those investments. But secondly, the revenue quantum and growth once they're post-revenue is astronomical. Just to pluck various different companies from in that sector for us, we've got one of them who I am pretty dead certain is going to do 14 times their revenue this year that they did last year in their second year of revenue. Those are good, proper, solid, bankable revenue numbers. We've got another one who we don't normally speak this crazily, but we can see a way for them getting well north of $1 billion of revenue by the end of this decade. And so that's the only sector where I am really comfortable standing up for very high valuations at the early stage because the potential payouts are so skewed versus what most of us in tech and VC worlds know at this stage. But classically, 8 to 10 times current revenues for SaaS. Recently, that's got ahead of itself. I'm pretty worried about a correction. I think the Ukraine could play out to be part of what that is. I do think things are coming back in. However, there's dry powder on the margins. And I just spoke this morning to a founder in the payments infrastructure space, and he's getting his hands ripped off by strategic investors and VCs at pretty punchy levels. And I can see why. Like, payments infrastructure is still pretty nascent, especially when it comes to data access, and the money's got to go somewhere. And also, if you're going to overpay, let's say you overpay 40% versus fair value. As an investor, it's much easier to overpay by 40% versus fair value at a 10 to 15 million pound valuation than it is at a £500,000 to 700 million valuation.
How's that trickling down to where we usually sit, which is angel seed investments? Because you've got a huge amount of capital at these later stages. And like you said, there's so much dry powder. I mean, even if you just look at the UK with pension fund reforms coming in and hopefully opening it up so that these larger institutional investors can play in, what's that going to do at seed, at the angel level?
Yeah. Firstly, angel money is going later now. So when we set up 4 to 5 years ago, we could do probably £4 million of funding from private investors. And now we reckon we can do about 12 million of funding from private investors. Now, part of that is private investors doing more at the normal average ticket size, 25 to 200 level. But what we're also seeing is larger ticket and later stage investors coming earlier. So family offices and ultra high net worths are now much more involved at this earlier stage. And we'll regularly be seeing 200, 500, 700 million plus tickets from private investors at earlier stage. The corporate market is absolutely moving down. Pretty much every corporate now has venture investing, but some do it very, very well. And the ones who do it best, I think, have flex. If I look at how BP has run theirs, they are stage agnostic, which means you can see BP easily coming into a pre-seed or a seed round. And we're seeing that reflected across others. There's a lot we rate, RGA, Coca-Cola. There's tons who we see working in that space. But at the early stage, private investors are going later, Series A+, and the later stage investors are coming much earlier, which kind of means it's a more crowded market from an investor perspective. But I think we've all got to stick to our guns, because there's one thing in growth and tech is you can't back an average company, and you definitely can't back a bad company because your downside is to zero. What I've thought to myself in the last 6 months as valuations have really flown and the market's feeling quite hot and money's quite easy to access is when the market's not doing a brilliant job of differentiating quality and risk-adjusted return, I've got to work much harder for it. This sounds very obvious, but whether someone's a new investor or a pretty experienced one, a return comes down to 5 main questions and 1 tag question, which is, what price do I get in? What price do I get out? How long will that take me? What do I think is the execution risk of achieving that? And how diluted might I get? And if you can get yourself comfortable on those 5 questions, and by the way, there's only 2 that you can really sort of influence right now, which is what is the valuation and also the execution risk. That should give you a pretty good idea of whether you want to invest or not, and also how to size it. And then the tag-on question is, will I enjoy this journey and will I be proud of it? And that's so important. Like Trail sold last year, and it was just every investor in it absolutely loved that trade. And it wasn't a multi-10x return for anyone, but the company did what they said they're going to do. They communicated well with shareholders. They built a B2B SaaS product of quality. They said they were going to sell. They sold. And at the end of it, there was just a massive metaphorical round of applause for investors. Whereas I can think of another investment I'm in, which did a sort of 10x return in the first 2 years. And most people don't want to be in the same room as the founder. So there is this extra element on top of, will this be something that's enjoyable for us?
I appreciate we've dug a lot into Addie, the investor. I'm wondering if we can switch a little bit to talk about you, the person, and kind of what you ultimately want to achieve with Adelpha, because you've 5 years. Congratulations on hitting that. What are you hoping to do over the next 5 to 10?
Yeah. If I step back from the end goal, what I really want to do is be proud of my lifetime contribution. I do want to earn a decent bit of money. I do want to live in a nice house. I don't have crazily high expenditures. I want to go to the Isle of Wight and race my boats. I don't need to go and own a house in Mustique. But what I really would like my gravestone to say is sort of, here lies Addie Pinkster. She made a difference to these people. She made a difference to these companies, or maybe small. And the net contribution on the world was this. I like the idea of having a legacy. And I didn't have that in banking. That was probably the thing that shifted me out. I didn't mind not having that for 10 or 15 years. But got to a point where I wanted more than my P&L to show for myself. Aside from work, I'm really proud of my family, my husband, my kids, and we still all like each other, which is lovely. My children are in an age now where there's a lot of pressure on parents about what the education system looks like and mental health. And what I want above all is for my children to be happy, fulfilled, confident, and able to make a contribution in life. And I think the litmus test of whether I've done my job how I want to as a parent is, in their 20s and onwards, do they have meaningful friendships and relationships? Are they able to find a really happy match for a lifetime partner? And are we still close to them? And sort of combining those 2 bits, the gravestone on the one side and what I want my family to look like when my children are in their 20s, kind of gets me to where I am. The funny thing about that is, if I then back up from there to Adelpha today, is I don't want much more from Adelpha. I'm a cricketer. So Adelpha is a company that hits singles, and occasionally a 6 comes along and we take a measured hit, but it's not a company that's trying to hit 6s. So we get approached sometimes to go in-house to a big bank, or there was a while where I thought we were going to try and look like Lazards and big office in Mayfair with marble foyer and lots of receptionists. We were all going to be male just to really sort of prove our point about feminism. And we even started growing the team. We got up to 15 full-time employees. And I realized that actually it just isn't what makes me happy. I'm not great at managing people. I don't know. I love transactions. I love companies. I love growth. I love investors. I love the team at Adelpha. But we're not trying to become a superpower. We want to be a company that, and same whether we set up funds and things, which we could possibly do, but I'm not sure. What I want to do is just do higher and higher quality deals. And for those who have heard of us, to think of us as the best. We don't need to be known by lots of people. We don't need to have a massive distribution list. We don't need to have a team of 100 and we don't need to be doing 1 million deals a year. The deals we do, we need to be super, super proud of. And we want to sit back and watch those companies make a massive effect on the world. And I guess what I really love is when someone, a founder or an investor, phones me up at the end of a day or after a deal or after an exit and says, "You freaking smashed that. Thank you very much."
Adelpha's obviously been successful. You're doing well. You've got this family. And one of the things that I don't think people know is that you do a lot of charity work as well. You've got the October Club. You've been helping trying to find host families for people in the Ukraine. Like first, amazing work with that. But second, how do you find time? Because corporate finance, youngish family, how are you fitting in the hours to do all these other things, going sailing? How do you get that balance?
Yeah, I'm pretty black and white. I'm either on or I'm off, which is why it's really important to me in a career or even in a transaction to make sure I really believe in it. Because if I believe in something, I can work very hard and it feels easy and fun and fulfilling. But if I don't fully believe in it, it's like pushing mud uphill and really exhausting. I can't do my best. A lot of people look at me like I'm 100 miles an hour all the time. And maybe that's how I present out sometimes. But actually, on the inside, I am black and white. I mean, half a day a week, I pretty much sit in front of the TV for half a day in my pajamas and just chill. If I'm not out in the evenings, I will be home with my husband just watching TV. I do a lot of walking with girlfriends. We were talking earlier. I went to Screwfix this morning on the way. I spoke to my 3 good girlfriends about various things like that. When I downtime aggressively. When I uptime, I go very fast at that. But it's one or the other with me. There are times where I have to make space for it. Last week was a busy week for us. We did $250 million of transactions in Q1, and they were all due to have closed last week. But I definitely wanted to give a space a week in case anything had legacy follow-ons. Actually, it didn't, but I knew that I couldn't start on new projects without being really comfortable with everything else we put away. And it was my birthday and my son changed schools and my other son goes to a different school. And I just knew that was a week where I had to put a spacer in and actually be a mum for a week, frankly. So I space time in the day, I space time in the week. And the game changer for me, if anyone's a reader, is Bruce Daisley's book, The Joy of Work, which is 15 chapters each with really good insights. But he sort of says the ideal day is get up and spend a couple of hours doing your emails. You can do that in bed, in the cafe, wherever you want to. Then do monk mode. So you do 2 or 3 hours of really sitting down with no interruptions, notifications off on the thing that you need to put away. And then you spend your afternoon socializing, whether that's the water cooler moment or getting an idea aboard with someone or just checking in with someone or going to do a pitch or whatever else it is. And that sort of day works very well for me. And my kind of even better if, I just don't do enough exercise. I do a lot of meditative reflection. I do lots of walks dogs and that, but I don't do enough real exercise. And hopefully if you were to talk to me this time next year, the final piece in the puzzle is I'll feel my heartbeat more often.
If I had to say, if there's one thing you could have done differently or do differently, would it be the exercise or would it be something else?
Yeah, it would. Right now, I'm a bit more forgiving on myself to say, hey, I haven't done enough exercise in the last 10 years, which I haven't, but it's more that I really hope that I can make a difference in that in the future. I just want to exercise.
For anyone who wants to find out more about you and your work in Adelpha, what should they do?
That is tricky because we're quite a low profile organization. We have the odd social media here and there. I mean, LinkedIn's worth following. We generally can't talk about our deals, but we'll normally publish a sort of vague article around a sector that we've been doing work in. And that gives the opportunity for people to lean in if they want to. If people are really interested in getting in touch with us as an investor, they can LinkedIn, reach out to me or go through our website. But in general, we're pretty low profile. What we sort of say is once a quarter, we'll do something that helped the community and the investment world move forward, and you're our thing this quarter because we rate you guys massively. We believe in relationships rather than sort of scalable networking. So if someone wants to come and have a chat. We'd love to talk.
For anyone who's just starting out on angel investing or early stage investing, what one piece of advice would you like to leave them with?
Go small to start with. Enjoy it for the process as it is. It's an education. If something goes really, really well, you won't particularly regret not being bigger. In most cases, people put too big a tickets in to their first few investments and they don't have enough dry powder for a year later when they're shown better stuff and they have a better way to differentiate between it. And have some running buddies and really challenge yourself for your unconscious bias. Try not to invest with the same mates in the same stuff all the time, because I think that's when important questions get asked less. It's funny, I think you guys and us get on really well because we're sort of doing the same thing from different angles. You're doing it statistically and we're doing it qualitatively, but looking at the statistics underneath it. And you're offering people the opportunity to be in a diversified fund, whereas we are absolutely putting the onus on investors to make their own investment decisions. But on that basis, and if people buy into anything I say, I think you could do a lot worse than having a chat with you guys to both sort of see the deal flow, see some of the process come through, and then just think of it as a learning curve to start with. It's investment in your own development to start with.
I couldn't agree more. Definitely learn the ropes before you go deep into it.
And enjoy learning. Don't feel out of your depth. Like, take pleasure in the learning. When was the last time you really got your teeth into something and learned a lot about it?
Oh, definitely. Well, Addie, it's been an absolute pleasure having you on the show. Thank you for the wealth of knowledge that you've left us with. I do hope people have a look at Adelpha Group and what you're doing. I think it's quite easy to see why you've been ranked one of the top 100 most influential women in Europe. And we joked about this, but alphabetically, you're number one on the list. So
my son had a look and he said, he's like, Mum, you're number one on the list. I was like, I am, darling. That's because my first name begins with an A, but I'll take it. In fact, we win really well because my first name, Addie, is AD and Adelpha is AD. So whether it's investor in a list of individuals, I'm at the top. And if it's a list of banks, even with Goldman Sachs and Jefferies and Morgan Stanley and JP Morgan, it's still Adelpha at the top. And it's what Jeff Bezos said about Amazon. If in doubt, set up a company beginning with A, and if in doubt, give your child a name beginning with A. That's my top tip for the day.
Access Fund?
Exactly.
No, it has been a pleasure. Thank you very much. Well, I hope you enjoyed that episode of Angel Insights. And if you'd like to stay in the loop, please do register at www.syndicateroom.com or follow me at Tom Britton or at SyndicateRoom on Twitter. And be sure to tune in a few weeks' time for our next episode. It's going to be a good one. Bye.